We got a nice rally going. We got banks up. We got home builders on the upside. Thank you, Esther George. Just take a look at what's moving here. And again, you got that bank rally, and you got the home builders rallying on some comments from Esther George there. That's moving yields. Semiconductors, these are classic cyclicals, and industrials leading the way. Utilities are lagging. This is a very typical pattern when we see cyclicals up and the defensive stocks moving to the downside. Just show you the S&P futures here. As George interview this morning saying, I'm not ready to provide more policy accommodation. That's right here. So you see markets moving up here and slightly down as we go into, and as the markets open, we're a little bit higher overall. So the point about the direction of the market is stocks are tending to move in the direction of yields, particularly 10-year yields. Yields up. Market up, yields down, market down. You can argue about whether there's going to be 2 rate cuts this year, 3 or 4. There's all sorts of camps on this. But for the market, the stock market, in the intermediate term, we are moving in the direction of bond yields. There's the S&P 500. 2940 has been a real problem for the markets. We keep trying to get over that. If we can get over that towards 2950, the bulls are going to come out all over the place and say we're at 3,000. But this has been a real resistance point. We just haven't been able to get over that right now. Europe is sort of flattish on either side of positive or negative. I just want to point out all this week the bulls have been saying, oh, the manufacturing numbers are going to be really lousy and the ECB is going to get very aggressive cutting rates. Well, the numbers came out. They were weak, but they were not as weak as people feared. So overall, Eurozone 47 from 46.5 the prior month. And remember, these indexes above 50, expansion, below 50 is contraction. So that's still weak, but it wasn't as bad as people were afraid of. France is 51. That was better than people expected. Germany, you see how weak Germany is? This is manufacturing now, not services. 43, but it was 43.2 in July. So this number even was better than weakness. So yes, crummy numbers, not encouraging, but not as bad as people feared. And that's a little bit of good news for people who are afraid the ECB is just going to go crazy and keep cutting interest rates here. Here in the U.S., everybody's very happy about Nordstrom, okay? And it's good news. So the margins were better, and that's one of the reasons it's up. Can I just point out, not to be a spoilsport, we're down 20% on Nordstrom for this month going into this number. We're down 36% for the year on Nordstrom. That's with the improvement that we're seeing today. This is a horrible year for the company overall. It's been a horrible year for the department stores. And there's a number of obvious reasons for that. There's a little bit of good news short term on the recent numbers. Guidance, which is the most important thing overall. Affirmed at Lowe's, TJX, Home Depot, Kohl's, raised the target, Walmart. Nordstrom lowered the high end of its guidance. Let me be very particular about that. It's not a complete cut, but they lowered the high end of the guidance. They're one of the few ones to move it to the downside. What we can see here is the trends. Keep your eye on the broad trend and what's going on overall here. So the department store trends here. So we've got discounting is up. We've got soft traffic, and we have little or negative sales growth. They can't open more stores because the costs are growing up. So that's the key point here. There is no path to growth for the department stores. That's why things have been so crummy this year. And fortunately, there's an ETF for that. So we tend to take a look at the XRT. This is the ETF that's basically a basket of all the big retailers that are out there. That's this one here for the year. You can see it's down for the year. This is mostly brick and mortars. There are ETFs that are like for online retailers. There's one. This is iBuy, I-B-U-Y. And they have people like Interactive on it, Expedia, Shutterfly, IAC. That one is up 23% on the year. So the market is clearly distinguishing between people who are growing and people who are not. And you can see that in the retail ETFs.